Every country on earth is in debt. Not metaphorically. Not politically. Literally. The numbers are so large they've lost their meaning. Trillions upon trillions. Numbers so big they no longer feel real, just background noise in the news cycle. But there's a question almost no one stops to ask. If everyone is in debt, who is actually being paid? Because debt, by definition, has two sides. A borrower and a lender. So if nations, governments, corporations, and households all owe money at the same time, then logically, someone must be sitting on the other side of that equation, collecting. Here's where the story becomes uncomfortable. When you follow the trail, not the headlines, not the politics, but the actual flow of money, something strange appears. The world doesn't owe its debt to some single outside force. It owes it to itself. Governments owe their own institutions. Central banks owe treasuries. Pension funds own government bonds. Banks lend money created from government debt back to governments again. It's circular. Self-referential. Closed. And yet, despite this closed loop, interest is paid. Constantly. Relentlessly. Every year. Every budget. Every crisis. So where does that interest come from? It comes from work. From taxes. From production. From people who don't own the system, but are required to sustain it. This is the first illusion to break. Government debt is not a mistake. It is not a temporary emergency. It is not a failure to balance the books. It is the foundation. A structure so deeply embedded into the modern economy that removing it wouldn't fix the system. It would destroy it. That's why debt is never eliminated. Only extended. Rolled over. Renamed. Restructured. Because the moment debt disappears, the money disappears with it. And that's the paradox no one explains. Paying off the debt would collapse the system. Defaulting would collapse the system. Not borrowing would collapse the system. So governments borrow forever, not because they're irresponsible, but because the system requires them to. This isn't about corruption in the usual sense. It's about design. Over centuries, a financial architecture was built where debt is permanent, interest is eternal, and crises are not accidents. They are pressure valves. And once you see that, the conversation changes. The question is no longer, how do we fix the debt? The real question becomes, who benefits from a system that can never allow debt to end? To answer that, we need to go back, not to modern politics, not to recent crises, but to the moment debt stopped being a problem and became a feature. That's where the story really begins. Most people are taught to think about government debt in very simple terms. A country borrows too much. It spends irresponsibly. Eventually, it must pay the bill. This framing feels intuitive because it mirrors household debt. If you max out a credit card, the solution is obvious. Spend less, pay it down, close the balance. But this analogy is completely false. Governments do not operate like households. And more importantly, they cannot. Every election cycle, debt is presented as a looming disaster. A ticking time bomb. Something future generations will have to pay back. Yet decade after decade, the debt grows. Governments change. Parties rotate. Policies shift. And still nothing is ever paid off. That's not incompetence. That's consistency. Because the truth is uncomfortable. There is no mechanism designed to eliminate government debt. Only mechanisms designed to manage it. When politicians promise to reduce the debt, what they actually mean is slowing its growth. When they promise to balance the budget, they mean for 1 year, while the total stock of debt remains untouched. When they talk about fiscal responsibility, they're talking about confidence, not repayment. And confidence is everything. As long as markets believe a government will continue paying interest, the system holds. Not repaying the principal is irrelevant. In fact, repaying it would be dangerous. Here's why. Modern money doesn't exist independently of debt. It is created through debt. When a government issues bonds, new money enters the system. When banks buy those bonds, they create deposits. When central banks step in, they create reserves. Remove the debt, and you remove the money that depends on it. This is why paying everything off isn't just unrealistic, it's destructive. It would cause deflation, liquidity collapse, credit contraction. In simple terms, economic paralysis. So debt remains. Always. Rolled forward. Refinanced. Extended into the future. And because the system cannot function without it, debt stops being treated as a failure. It becomes infrastructure. Roads are maintained. Power grids are maintained. Debt is maintained. Crises don't end the system, they reset its terms. A recession doesn't eliminate debt. A financial crash doesn't erase it. A bailout doesn't solve it. Each event simply redistributes risk, shifts ownership, and reinforces the same structure. That's why after every crisis, debt is higher than before. Not by accident, but by design. So the illusion is this. We are told debt is a problem waiting to be fixed. In reality, it is the mechanism keeping the entire system operational. And once you accept that, a deeper question emerges. If debt isn't meant to be solved, then who is it really serving? To answer that, we need to look at what debt actually does. Not in theory but in practice. Because debt doesn't just create money. It creates power. To understand who benefits, we have to strip debt of its moral framing. Debt isn't about irresponsibility. It isn't about failure. And it certainly isn't about discipline. Debt is a mechanism. At its core, government debt does three things simultaneously. It creates money. It guarantees interest. And it concentrates control. Let's start with creation. When a government issues debt, it isn't borrowing existing money in the way people imagine. It's authorizing the creation of new financial assets. A bond is issued. Banks buy it. Central banks stand ready to support it. And suddenly, money that didn't exist before is now circulating. This is why debt expansion often feels invisible. No vault is being emptied. No savings are being drained. The money appears, backed not by gold, not by production, but by the promise of future taxation. That promise is key. Because while money is created instantly, repayment is deferred indefinitely. Sometimes decades. Often forever. And during that entire period, interest flows. That's the second function. Interest is not a side effect of debt. It is the point. Interest ensures a permanent transfer from the productive economy to the financial layer above it. From workers to institutions. From taxpayers to asset holders. Every year, governments allocate massive portions of their budgets not to services, not to infrastructure, but to debt service. And this payment is treated as sacred. Budgets can be cut. Programs can be reduced. Wages can stagnate. But interest must be paid. Because failing to pay interest doesn't just upset creditors, it threatens confidence. And confidence is what keeps the system alive. This is where debt becomes power. Whoever controls the issuance of debt controls the flow of money. Whoever holds the debt controls future tax streams. And whoever manages the system decides who gets rescued, and who doesn't. This is why debt is never neutral. It shapes policy. It limits choices. It defines what is possible. A government drowning in debt doesn't ask, what does society need? It asks, what will markets accept? And markets accept one thing above all else. Continued interest payments. This is why austerity always follows crises. Why public services are cut while bondholders are protected. Why bailouts stabilize financial institutions, not households. The system isn't broken when this happens. It's behaving exactly as intended. Debt creates dependency. Once a government enters this cycle, it cannot exit without triggering collapse. So it adjusts everything else instead, spending, wages, policy, priorities. And this dependency isn't limited to one country. Because the next layer of the system ensures debt is no longer local. It's global. And once debt goes global, escape becomes almost impossible. That's the next step in the architecture. And it's where the trap truly closes. Debt becomes truly powerful when it stops being contained. As long as debt is local, default is possible. Painful but possible. A government can refuse to pay. Creditors lose money. The system resets. But modern debt is no longer local. It's interconnected. Government bonds don't sit in one place owned by one lender. They move. They're traded. They're bundled, pledged, rehypothecated, and embedded deep inside the financial system. A single bond can pass through dozens of hands. A pension fund buys it. A bank uses it as collateral. An insurance company holds it for stability. A central bank accepts it as a reserve asset. Now imagine what default actually means in this environment. It doesn't just hurt one creditor. It destabilizes balance sheets across borders. It freezes lending. It breaks trust between institutions that rely on each other's assets. Default stops being a political decision. It becomes a systemic threat. This is why governments are told they cannot default, even when their populations are suffering. Because default is no longer framed as a reset. It's framed as contagion. And once debt is global, every country becomes responsible not just for itself, but for the stability of everyone else. That's how control scales. A nation's economic policy stops being domestic. It becomes conditional. Budgets must satisfy bond markets. Spending must reassure rating agencies. Policy must align with global capital flows. Sovereignty doesn't disappear overnight. It erodes quietly, through constraints. And this web ensures one thing above all else. Debt must be serviced. At any cost. If a country struggles, it isn't released from debt. It's restructured. New loans are issued, not to reduce the burden but to keep interest flowing. Old debts are extended. Terms are adjusted. Conditions are imposed. This is sold as assistance, as stability, as responsible governance. But the result is always the same. The principle remains. The interest continues. And dependency deepens. This is why global debt never shrinks. It migrates. From private to public. From banks to governments. From governments to international institutions. Losses are socialized. Control is centralized. And every crisis reinforces the same message. There is no exit. Because the moment one country breaks the chain, the entire structure is threatened. That's the brilliance of the design. Debt is no longer enforced by force. It's enforced by interdependence. And at the center of this web sit the institutions that manage it. They don't need to conspire. They don't need to coordinate in secret. The system itself does the work. Which brings us to the final question. If everyone owes, and no one can leave, who is actually winning? That answer leads us to the top of the pyramid, and to why crises never change who holds power. That's next. When people talk about government debt, they often imagine foreign enemies, rival nations, or some external creditor pulling the strings. That image is convenient. It's also wrong. Most government debt is owned domestically, by institutions, not individuals. Pension funds, insurance companies, mutual funds, banks, central banks. On paper this sounds reassuring. We owe it to ourselves. But that phrase hides more than it explains. Because who inside that ourselves actually receives the money? Every year, governments collect taxes from workers, businesses, and consumers. A portion of that revenue is set aside for one purpose before almost anything else: paying interest. Those interest payments don't disappear. They flow directly to the institutions holding government bonds. And those institutions are overwhelmingly owned and controlled by the wealthiest segment of society. So the cycle looks like this. Work creates value. Taxes are collected. Interest is paid. Capital accumulates. Over and over. Year after year. No vote is taken on this transfer. No debate questions whether it should continue. It's treated as a technical necessity, not a political choice. And because the debt is never eliminated, the payments never stop. This is why debt service quietly becomes one of the largest line items in national budgets. Larger than education in some countries. Larger than healthcare in others. Yet it rarely sparks outrage. Because it isn't called what it is. It's not framed as redistribution. It's framed as obligation. And this mechanism scales globally. Japanese debt is held by Japanese institutions. European debt by European banks. American debt by American asset managers. But those same institutions also hold each other's debt. Cross-ownership creates insulation. If one government struggles, others step in, not out of solidarity but out of self-preservation. Because losses in one place ripple everywhere. This is why bailouts look inevitable in hindsight. Why too big to fail becomes doctrine. Why the same institutions survive every crisis, larger than before. Debt doesn't just transfer money. It transfers leverage. Governments become dependent on bond markets. Markets become dependent on central banks. Central banks become guardians of confidence. And confidence, once again, is the only thing holding the structure together. The public is told this system is necessary. That there is no alternative. That this is simply how modern finance works. And in a narrow technical sense, that's true. Because the system has been designed so that questioning it feels more dangerous than accepting it. Which brings us to the final realization. The system doesn't collapse because it's fragile. It survives because it's resilient. Resilient to outrage. Resilient to elections. Resilient to crisis. And that resilience exists for one reason. Debt is not a bug in the system. It is the system. Now we can finally see the full picture, and why this structure was never meant to end. That's the last piece. By now the pattern should be clear. Debt isn't spiraling out of control. It's doing exactly what it was built to do. It creates money without limits. It guarantees permanent interest flows. It locks governments into dependence. And it concentrates power in institutions that never face elections. This is why the same conversations repeat every decade. We must address the debt. We must reduce the deficit. We must restore fiscal discipline. And yet, the numbers only go in one direction. Because eliminating debt would dismantle the system that relies on it. If governments stopped borrowing, money creation would stall. If debt were paid off, liquidity would vanish. If interest stopped flowing, balance sheets across the world would break. So the system chooses continuity over resolution. Debt is rolled forward. Crises are managed, not solved. And each emergency becomes justification for expanding the same framework. This is not about incompetence. It's not even about greed in the traditional sense. It's about incentives. A system that rewards those who manage debt will always produce more debt. A system that depends on interest will never allow repayment. A system built on confidence will always prioritize stability over fairness. And once the structure is in place, no single actor needs to control it. Politicians come and go. Bankers change. Institutions evolve. But the architecture remains. That's why debt survives wars, revolutions, and regime changes. That's why financial crises never rewrite the rules, they reinforce them. And that's why every generation is told the same story: this is temporary. It never is. Because debt isn't a crisis to be solved. It's the foundation of modern economic power. And once you see that, you can't unsee it. You stop asking why the debt is so high. You start asking who benefits from it staying that way. That's the perspective we focus on here. If this changed how you see government debt, if you now understand that these numbers aren't accidents but design, then you're already thinking differently. This channel exists to trace how financial systems were built, who they were built for, and how they continue to shape the world beneath the headlines. This is Finance Archives. Subscribe if you want to understand how the machine actually works, because they won't teach you this in school. They'll tell you debt is a problem to fix. The architects knew better. Debt isn't the problem. It's the rent we all pay to live inside the system. There's one last thing worth saying. Systems like this don't survive because people are stupid. They survive because they're abstract. No single law explains them. No single villain controls them. No single moment marks their creation. They're built layer by layer, quietly, until questioning them feels unrealistic. By the time most people encounter government debt, it's already framed as fate, as math, as inevitability. And that framing is the final defense. Because once debt is treated as natural, like gravity or weather, no one asks who designed the landscape. But every system has authors. Every structure has incentives. And every incentive shapes behavior. Debt didn't become permanent by accident. Interest didn't become sacred by coincidence. And crises didn't become routine on their own. This isn't about predicting collapse. The system isn't fragile, it's durable. It can run like this for decades longer. As long as confidence holds. As long as payments continue. As long as people believe there is no alternative. Understanding that doesn't make you powerless. It gives you clarity. Because once you see debt not as a mistake but as architecture, you stop waiting for it to be fixed. You start watching how it's used. Who is protected? Who absorbs the cost? Who decides what stability means, and for whom? That's what this channel is about. Not outrage. Not panic. But understanding. This is Finance Archives. If you want to keep pulling these systems apart, calmly, clearly, and without slogans, subscribe. Because the most powerful systems don't rely on force. They rely on not being seen.